There's a lot of debate at the moment around which is better, passive or active. And in our view, both of them have got extremely strong positives and extremely strong positives and potential negatives. What we've identified in South Africa is that over time, the local active asset management fraternity has done exceptionally well. And most of your investors have, over time, invested with those active asset managers, have done extremely well over the years. So if you can think back to the year 2003, when we saw managers, an example of a manager who did extremely well in that year was the Investec Value Fund, with a return of 40% relative to the market, which gave you minus 8%. That is a 48% outperformance of the market. That sort of return really galvanized the idea of active asset management in the minds of local investors and local investors, and that's really been the sense that most investors have had over the past almost 15 years. More recently, what we've identified is that your investors have become slightly more aware of the underperformance of the active asset managers relative to the benchmarks. So what this has meant is that investors are now asking the question, well, Mr. Asset Manager, I'm paying you this fee, but you are not outperforming the benchmark that I'm paying you to outperform. Why is that? And more difficult questions are being asked of active asset managers, especially in this environment over the past couple of years. As I said 15 years ago, the discussion on passive investing was really something that was only happening in the corridors. So more recently, with your active asset managers now starting to underperform, as an example, in 2014, we saw 2/3 of active asset managers actually underperforming the benchmark. And that's one of the key reasons why we saw passive investing over these past couple of years becoming more and more popular.